Hello guys, what is happening and welcome to this video. So in today's video we are going through housing investors are heading for the exits as rates rise. So this is going to be an interesting article that I found on BNN, which we're going to dig into today. I'm much better from last Friday's live stream. I had a headache, so I was finding it really difficult to think through what I was saying. Because the thing is, here on live streams, you can't edit these, so you have to kind of think through what you're saying. So anyway, please hit that like button. It helps get the video out there. We're going to head into this right now and see exactly what they're saying. And we've got some of our classic real estate experts who are commenting on this. So it's going to be an interesting one today. So housing investors are heading for the exits as rates rise. So let's see exactly what they're saying. At the tail end of a historic bull run in Canada's housing market last year, investors came to compromise a fifth of the country's home buyers. Now they are some of the first scrambling to unload properties in what some are already saying could be the most severe housing market downturn in the country's recent history. I don't really think that's an understatement, because let's face it, the two most recent downturns, 2008 and 2017, I guess, if you could even count that as a downturn, have been very, very insignificant in the price reductions that have happened and the effect on the actual median prices city to city. Really unaffected. And it wasn't happening as a national thing either. You didn't have nearly all markets getting affected by this, because I remember in 2017 being in Toronto and all the suburbs were going crazy when Toronto was falling in value. So, there's different things that happen there. But, what's interesting is they are saying about investors unloading property, which has already happened in a lot of cases. I think this article is kind of late to the point here. But, I was actually a property management company last week, and I was talking to the guy, and, he gave me some great information on what has been happening. And I can only really speak for here in Calgary and comment on that rental market. But essentially, it's going to be the same in the United States. It's going to be the same across Canada as well. Basically, because housing prices went up by so much, a lot of landlords thought, well, this is a great time to sell and get out of this investment, make a tidy profit. Some of those people hadn't even bought that long ago. For one, I know our old landlord in Milton, because I know them well, and they were a fantastic couple, and we're friends with them on Facebook. And I know that they sold the townhouse that they were renting out and we were renting out, and we were the first tenants of that property. It was a brand new property. And they've now sold it, and they sold it in 2021. So I don't doubt that this is something that has happened nationally, both in the United States and Canada, where essentially the people who are emotionally detached, and that is very important. A lot of investors who are renting out rental properties, they're not emotionally attached to that property. So they will actually go in there and sell it. Whereas if you're an actual home buyer and homeowner and you're living in that, boy, you have a different attachment to that property than somebody who is an investor. And that part of that psychology aspect of it is why personally I think owning real estate and living in it is a bad idea, because it turns into a money pit, as ScottWalters and many other people say. It's much better to own investment properties, because then you can be emotionally detached from that investment property. But having said that, It's only the smart investors that took profit last year. Most of them still in the game, suffering from greed and everything else. And really, it goes back to the trading statistics. 70-80% of people lose money in trading. It will be that 70-80% that didn't sell. And that's exactly what the guy told me at the property management company. He said we saw about 1/5 of our inventory disappear because landlords were selling. So that happened. He says it's really starting to normalize now, which I found interesting anyway. And I've got a video that I'd filmed before I spoke to this guy last Friday where I talk about how rent prices peaked. And maybe if you're interested in more of a deep dive into that video, then let me know in the comments on that video. That'll be out on Wednesday. And yeah, we'll maybe do a dive into that. So let's have a further look what they're saying. In early July, Toronto-based mortgage broker Ron Butler's clients called him with exactly that dilemma. The financials on the suburban condo he purchased as an investment property just 4 months earlier no longer made sense. Rents could no longer cover interest payments on the mortgage after a 6-fold jump in the central bank rate. So obviously this guy took out a variable rate mortgage. And, essentially, that was a disastrous thing to do. And even, people were asking me about that before the rates even rose. And I was kind of saying, like, if you are going to go into this housing market, at least fix your payments, because it's just going to get, who knows how far this thing is going to go. And it's gone pretty far, in my opinion, further than I ever thought it would go, to be honest. It's absolutely surpassed my expectations. I never thought we'd get rates to where we're going to have them come September. And really, it's impressed me a lot of how much they've raised rates. And Canada has been one of the countries that has tightened very aggressively. I say very aggressively, but when inflation is running at 8 or 9%, and you've got the policy rate at 2.5% or 3% or wherever it is, that's really still large negative rates. But the thing is, what you've got to understand is it doesn't matter about that so much, because you have to think about how much debt is outstanding in the economy. So this works for any economy. And if there's a ton of debt outstanding, then yeah, you better believe that increasing the interest rates by that much is going to have a massive effect. It's going to have a massive effect on households, which is becoming visible instantaneously. And it's also going to have a massive effect on businesses too. 2 months in a row now, we've seen jobs lost in Canada. And, this comes after pretty much March, when home prices started to go down. So how much has that had an effect on unemployment? Is the same thing about to happen in the United States now? Because they seem to be like 2-3 months behind what's happening in Canada. So I think it's interesting where we're at, and I still think we could see some type of bull trap in the middle. Maybe even this month, next month, it could come sooner than people expect. And that won't be driven by any sort of fundamentals, but it will just be a fact of, certain places can rise because of low inventories still, and you could just have a rush of people with their pre-approvals expiring heading in to the market. So I think it really, really is interesting. Greg says, one of my co-workers said his mortgage has gone up $600 a month. I don't care. Let it burn. Man, that is absolutely insane. $600 a month. I mean, I overheard a conversation the other day, and I won't go into too much of the details of it, but, it was basically, this guy was saying, like, if I can save $100 or $200 a month, then that's fantastic, because he's actually going into debt more and more and more. And I was just like, $200 a month these days, like, people like that are just going to be trashed coming into a recession. And, you know, a lot of people who rent, they don't have significant amounts of money on their balance sheet. A lot of people who are renting are typically younger. And what does that mean? It means that you're going to get people defaulting on rents. Now, is it a quick process to get people out? Well, you know, in some places, yes, maybe could be the answer to that. But the reality is, in most places, when it's all happening at the same time, it's not going to be. It's not going to be. I mean, it's kind of insane. I mean, dealing with the government in any country is just a disaster. But in Canada, it is just particularly awful, in my opinion. Like, they just takes forever to get anything done. It's like they're doing everything through owls, like in Harry Potter, where they've got to put the notes in the owls and they send them off across the country and the owl gets lost. And, you know, it's just absolutely insane. Anyway, that's just my rant about the government there. But yeah, I find it ridiculous when you really think about these things. So Butler advised his client to sell instead of losing money on the property each month. The Bank of Canada raised its benchmark rate another percentage point to 2.5% just a week later. So Butler is bracing himself for even more calls like that. It's starting now, Butler said. This is Ron Butler. You can follow him on Twitter. I've seen some of his tweets are good from what I've read. Some not so much. Well, you know what? It's kind of my bias because I've seen how people were framing this before, and I see how they're framing things after, and I'm just like, well, that doesn't jive with me because what you were saying before, you're completely like contradicting yourself right now. And of course, nobody ever admits they're wrong about what they've said, but you know, we're all going to be wrong at some point. Like, we're not going to get everything right, but I just find it, you know, people who are in that profession, like he obviously, I think, owns a mortgage business. So it's difficult, you know, because with people like that, they've got a massive bias on the market. So it kind of, and also any time that they can get airtime is good for their business. It's free marketing. So you just have to think, unfortunately, this is the way it is these days. A lot of people are just after, you know, put in the most stupid, like take example of the stock price targets. You know, half of the people who put out these ridiculous stock price targets are just trying to get their name out there so that they can be featured and then their name's out there, essentially. Well, it's the same thing in real estate. So it's, but yeah, so it says there it's starting now. So every quarter there's more bad news, more renewals, more negative cash flow, more does it make sense to hold on to this rental. As long as rates stay high, he predicts investors will turn into a steady stream of forced sellers and further weigh down home prices. The economics of this thing for the next 2 years just doesn't make sense, Butler said. So that's pretty interesting. And then it shows you the benchmark home price. And I haven't actually seen, so this chart's from Bloomberg. But yeah, you can see it's ticked down very significantly. Looks like a peak, but it remains to be seen. So interestingly enough, they've also got the interest rate chart on there, but that only goes to 1.5%. So I don't know what's up with that. So over the last year, central banks issued repeated warnings. You know, this is interesting because this has been parroted so much on Twitter, on FinTwit, where people are like, oh, the central bank, they said in 2020, just borrow, borrow, borrow. And they were very vague in 2020 about what they did say. I actually looked into all of this because when I saw the Bank of Canada trending a couple of months ago, I was just like, I swear I've heard them 2-3 times sound the alarm bell on the housing market, tell people prepare for rising rates. And they did actually. They've been saying it ever since March or April last year. Prepare for rising rates. Did anybody listen in 2021? No. Does anybody ever listen to the central bank? Only when they are saying what they want to hear. That's essentially what And it's like this for everything. And unfortunately, it brings me on to the topic of financial responsibility, because financial responsibility is one of those things that I believe you have to have. Otherwise, you are just going to be a loser in the financial world. Because essentially, if you cannot take responsibilities for your own mistakes, we all make mistakes. I've made tons of mistakes. I'm sure I'll make more mistakes. But if I don't take financial responsibility and I start blaming the Bank of Canada or the Fed or the ECB for whatever happening, like let's say I lose money on a stock investment or something like that, and I go, that was because of the Bank of Canada. The Bank of Canada did that to me. Then I can no longer learn from that event, because you're not taking financial responsibility and saying, yes, I did do this wrong, but how can I improve? How can I be better next time? And that brings me on to Scott's story. Think about what ScottWalters says, his story. Part of the reason that Scott is out here warning people is because he's been through the works of that firsthand. He's had firsthand experience of what happened in 2008, and he saw it this time, and he was like, it's the same thing all over again. So, and he's trying to warn other people. He doesn't want other people to get run over by the bus. So, it's crazy the environment we're in right now. But anyways, so it is not only are investors thought more likely to sell in a downturn because they don't live in the homes they own, the volume and type of debt they were taking on, specifically loans with a floating rate, could make them more likely to experience a financial squeeze if rates rose and prices fell. Now it looks like that's exactly what's happening. And, it was always a case that real estate was negative across Canada before rates rose this much. But now it's just got to the point where people are so squeezed, like it says in here, that there has to be a breaking point of that. And it will likely all come at the same time or near enough the same time period. And it could lead to like that capitulation type moment where people are just chasing the market down and prices just go down really fast. It happens so fast that people who listed and haven't moved their price are just like, what just happened? Like, and a prime example of that, and I put it on Twitter. You can follow me at MarketManiaCA if you want to see that. But I put a post of a picture. I was biking the other day, and I biked past this house, and I saw that I bike around the neighborhood and out in the provincial park that's close by. And basically, when I go around the neighborhood, I see the same houses for sale, same ones. So this one I knew had been for sale for a long time, but I saw that they'd added another just listed sign. I mean, they already had one, they added another. So now there's two signs outside, so it just looks desperate. So I got back, I took a picture for a start off, then I got back and I was like, how long has it been on the market? And it's like over 46 days now. Looked at the price, and they are completely out to lunch. I mean, they're asking $950 for a house that's worth probably about $700 max. I mean, they're just totally on a different planet. People like that are going to be the ones that maybe in 3-6 months are just like, what just happened? Like now you're saying my house is worth $400,000. Like, what's going on? But the thing is, it's like, I also posted this on Twitter. Greed and stubbornness will lead to your ass being handed to you, because greed and stubbornness is going to kill people in a market like this. Now, in a rising market, it's a different story. Those things always work. But in a declining market, they work to the contrary, so that they're actually a massive hindrance on you. And of course, people don't realize that they're all caught up in the emotions of owning real estate. I mean, most of the landlords are mom and pop landlords. And those people, they're all caught up in their emotions of everything. So essentially those type of things, greed, it's really going to bite, and it's going to bite and sting, and people are just going to get really ran down by that bus that I was talking about earlier with Scott. So it is, and this was really interesting. This is why I highlighted it. It came from David Rosenberg. David Rosenberg was on Macro Voices probably 2-3 months ago. If you haven't seen that episode, check it out, because David Rosenberg is really, really good in my opinion. And he was on the Macro Voices podcast. I always listen to that. I think it's a phenomenal podcast, wealth of knowledge on there. But check out the interview specifically with David Rosenberg, because I think you guys may be interested in what he was talking about there. He touches on many things, but his outlook was incredibly interesting. Investors in residential real estate are typically what you would call weak hands, said David Rosenberg, an economist, borrowing a term from poker. The momentum could build on itself, where the lower price beget even lower prices because of the forced selling by these leveraged weak hands. And I suppose what the crux of what he's talking about there is the fact that people have leveraged on leverage, making themselves weaker and more vulnerable to a downturn in prices. And this is what I've been saying this for over a year, is like when you have this amount of speculation in a market, it makes it extremely weak. And I've said this multiple times too, when everybody was parroting how, you know, there's so many investors buying, and that's just like that's a bullish signal for real estate prices. I was just like, what is going on? But you know what? I shouldn't have been trying to understand the mentality last year, because now, as I really start to assess the long-term outlook, which maybe we'll get into in another video, the long-term outlook, I'm kind of seeing now how this was that new paradigm moment that happens at the end of any trend. Like we've seen 50, 60 odd years of constant real estate appreciation, pretty much with ups and downs, but it's been in this massive uptrend to a point that people got there last year and they were saying it's never going to go down. Real estate never goes down, and if it goes down, it will go back up. And it was that new paradigm type moment that I think really defines the end of a trend. And then on top of that, you add things like inflation being at, you know, decade and decade highs, and really at the highest level since the 1940s, if it was actually measured accurately. When you see things like that, and you see the fact interest rates are now looking like they bottomed out, because the trend has changed trajectory now, because you've now got a newer high where it's surpassed the lower high from once before in the rate hiking cycle. There's a bunch of different indicators that are suggesting we could actually head into a real estate downtrend. And you add into the top of that demographics and all the rest of it, and it just all calculates into that. Now, I'm trying to think of different ways I could be wrong on that and try and work through that, and then do a video on it, essentially do a live stream on it maybe. But you know, that does not mean home prices can't go up, and I want to make that clear. I'm talking long term, like the next 30, 50 years. I'm just thinking, you know, that we could actually be seeing that reversal, especially what's happening with the US dollar, what's likely to happen over the next 10, 20 years. Yeah, home prices will go up, undoubtedly, at some point. But will they ever go up to the last high in real terms, in real inflation-adjusted terms? And that's what I'm really trying to... Because, you know, nothing lasts forever. It really doesn't. Like, everything at some point or another comes to an end, or the trend reverses, you know. And typically, when that happens, it happens at a moment where everybody reaches this new paradigm in the bubble, like I said, where everybody is just saying real estate only goes up, and it becomes a massively crowded trade. I mean, talk about the most crowded trade ever is real estate right now. So it's interesting, you know, it's just something to note. And having said that, I believe that in other countries, it could be quite the contrary to what could happen in the US, Canada, the UK, Europe, and places like that, where you actually see the opposite happen, where their real estate actually goes into an uptrend. So long-term uptrend. And why would that be? Growing middle classes in these countries. There's more wealth actually being generated because they're producing more things. And I think that's likely. I do think that's likely. So, and that's why I'm not interested in Canada or the United States or anywhere else to invest in Europe or anything like that. And I'm looking for more countries where I think there's going to be strong growth of the middle class. So yeah, it's interesting, but each their own. If you're looking for a home and you just want to buy and you want your payment fixed and everything like that, I get it. And if you live in the US, Canada, the UK, sometimes it's a better decision to buy versus rent, like especially if you have pets. That was another quick note I'll just make. Out of all the houses this property management had, and they had like a lot, it was a lot. I can't remember the exact number, but the guy pretty much said to me, 70% of those don't allow pets. So if you just have a pet, you're striked off like 70% of the inventory in a tight rental market like we have now nationally. You know, that is really tough. It's tough. And that's why the animal shelters are likely full. Well, they are full. Like I've seen all the stories about it. It's very, very sad. I think, you know, it was sad from the start because when I saw the boom of people getting pets in 2020, I thought this is just going to lead to a boom in the shelters. And that's exactly what it's leading to because, again, people just cannot take responsibility. And anyway, I'm not going to get too much off on that tangent. But yeah, so it's very, very interesting. So this is interesting too. Bubbles burst when interest rates go in the other direction, Rosenberg said. The question always is, when is the inflection point? And the inflection point has already arrived. So there you go. David Rosenberg right there saying the real estate market, he's calling a spade a spade. And, you know, you got to listen to him and his macro analysis of everything else as well, because I think it's really, really good. And that podcast, Macro Voices, check it out. So more than half of home buyers of all kinds, investors included, turn to the record low borrowing costs available through variable rate loans. Yes, because we all know you find safety in variable rates. I mean, God, the catch being the rates on those mortgages move in lockstep with the central bank's benchmark borrowing costs. And bear in mind, all those people who are blaming the central bank because of 2020 and bought after they warned about rising rates in 2021, you know, those people, again, they're just ridiculous. They deserve whatever they get. So at the same time, nearly a fifth of investors were also borrowing against old properties to finance the purchase of new ones. So this is leveraging them. Other bank research shows this. That type of debt, known as home equity line of credit, often carries a floating rate too. This makes investors more highly indebted overall, and central bank research shows that they are far more likely to have a total debt load 10 times their income. There may also be more like Butler's client who borrowed the down payment as well as the mortgage for a new property and so owe 100% of the purchase price of that debt has become considerably more expensive in just the past few months. So that's really explaining how people are leveraging, and this sort of leveraging happens in Canada and the United States. I'm not so sure about Australia and New Zealand, places like that, although I did hear that Australia, everybody has a variable rate mortgage out the door. People don't even fix it. So I think it's very, very bad for the housing market that people have done this, because these people are all going to be trashed. And it was the same in 2008. And the thing is, I did a great video actually that I'll pin in the comment, because I get asked this question all the time, and really, I've done a video on it prior, but it was before like the channel, the wind really caught the sails in this channel, I guess. But it's about how 2008, why that didn't happen in Canada. But anyway, going back to 2008, there was a report that was put out in 2017, 2018 that studied the 2008 financial collapse, all the people who were foreclosed on during that collapse in the US. And basically, it came to the conclusion that the framing that the mainstream media, surprise, surprise, gave it during the collapse, which was it was all subprime, it was all these risky loans, was in fact incorrect. That most of the people who were being foreclosed on during that period were people with great credit scores, but they leveraged multiple times, and essentially it cost them everything in the end. And the other key fact about that report was, and I'll have to dig it out again, we've gone through it on previous live streams ages ago, back in the winter. And but in that report, it also says how the share of people that went bankrupt was much higher in the younger age bracket. And it also had some great stuff in that report, but it really outlined that the framing of the whole narrative was just incorrect, that it was subprime and it was all subprime mortgages that caused it. The reality is it was people with good credit, people who seemingly didn't seem like they would default on a loan. And a lot of people's response is, well, we don't have non-recourse loans. Well, the thing is, most states in America don't have non-recourse loans either. Nevada is a great example of that, and their housing market incredibly volatile. So I think the notion that people aren't going to abandon their house just because there's non-recourse loans is ridiculous at best. The ultimate story is, if people can't afford to pay and they're in a bad financial situation, they're going to lose the home. And the fact is, the bank ain't going to be pursuing thousands and thousands of people, especially when the government has to come in and bail them out. So that won't happen. So you will see it happening on a wide scale, even like a cash for keys type scenario like you had in the US, where basically they were just trying to get people out the door, who didn't want to put up a fight. People still put up a fight, of course, as well. So it's pretty interesting, that report, and I'll have to dig it out. But yeah, for some investors, the situation is even more dire because they were losing money on their properties before the rise in rates. In Toronto and Vancouver investing circles, such negative cash flow was often justified because it was just a part of going to pay down the principal on a mortgage each month, increasing the investor's equity in an appreciating asset. I mean, I've said how ridiculous this mentality is. I think it's some of the dumbest investors in the world have entered into the market over the last year, because you have to be really out to lunch to take on a negative cash flow, a negative cash flowing asset that is based on the price of debt. Like, it's just, anybody who did their due diligence before they invested would know that there was a high proportion of risk. Because let's face it, guys, before 2021, there has been a lot of reports and a lot of people who have been sounding the alarm on the Canadian housing market, rightly so. People like Hilliard released 2 books on it, which is fantastic, and it's all backed up by data and everything like that. But that is just ridiculous. When you see people doing stuff like that, it makes you wonder. But obviously, like, if you're and the fact is, these investors, they are not, I guarantee it, they are not really tracking their expenses properly. So they think they're negative cash flow. They're probably even more negative cash flow than they even realize. And they probably haven't even factored in the lost opportunity cost of just putting that money in an S&P 500 ETF and riding it for the past 3 years with no maintenance. You don't have to worry about a tenant. I'm not saying do this. This isn't financial advice, but I'm just saying no maintenance. Well, there is a maintenance fee, but it's just. But anyway, it's minimal, and you can ride that S&P 500 much more safe than relying on a tenant, relying on a property that you've then got to maintain, and everything like that. And, it is really ridiculous, in my opinion. The risk reward is just so skewed more towards the risk being so much higher that you would have to be an idiot, clearly, to invest in that market. And I'm sorry for being blunt, but it's the pure, simple fact of the matter is, you would have to be pretty damn stupid to go into something like that. And now if you get your ass handed to you, well, you kind of deserve it for taking on that. So it's pretty much what it is. We're getting close to the point where even fixed payments are going to have to get ratcheted up, said Robert Cav, an economist at the Bank of Montreal. It could very well just deepen the near-term downturn. So there you have it. You have a bank actually coming out and saying that, an economist from a bank saying that lots of fixed payments are about to go up, folks. And I was saying on Twitter today, RBC's posted mortgage rates. Bond yields have gone down 20, 25%, 30%, something like that in some cases. And why aren't they passing on any of those costs in their posted mortgage rates? And the pure and simple answer is, it's very simple. It's because the risk premium has gone up because housing prices are going down. And the risk premium has also gone up because they think we're going into a recession. Now, whether the banks think that that's going to be inflationary or deflationary is a different story. I think they're on the side that it's going to be a deflationary recession. And that's why they're buying into safe haven things like bonds. But the bond market could very well have a leg down. And, Canada, the United States, many other countries rely on foreign countries to buy their debt in order to run these stupendous deficits that they run. So it's going to be very interesting to see where we go. So it is just crazy when you really think about it, where we are. So investors heading for the exits. And, it's just going to continue, and you're just going to get dumber and dumber as you go down the scale. And it's really like a pyramid scheme in the respect that you've got the smart, well, not smart, but the top people taking money first, then the bottom, and then it leaves the most people at the bottom who lose everything. And that's just the reality. And the thing is, anybody who buys a house in 2022, who buys a house right now, who buys a house in 2021 is taking a massive risk, in my opinion. And this isn't financial advice, but I just believe it's incredibly risky because heading into a recession, people don't know how secure their jobs are going to be. The difference is, if you're in a rental, you lose your job, maybe you can downsize and then you can save money that way. But if you're in a house that you can't sell with a big payment, you're screwed pretty much. And that's going to be the situation for so many people. I'm telling you guys, so many people. It's obvious. It's just blatantly obvious to me. So many people during 2021 got into the housing market emotionally. They got into the housing market buying more than they can afford, wanting more space. I mean, space was the big thing because of all the Loch Ness. I don't want to say the word because I know YouTube will have me for it. But yeah, because of all those things that happened where everyone was stuck inside their homes. But basically, that had a massive impact on what people wanted to go buy. And that's why they drove out 2 hours because they were working from home. And they said, yeah, we can buy in Brantford, Ontario, because what does it matter? We're working from home and it's not really likely. This is the 21st century. The mainstream media is telling me remote working will be the future forever. And it wasn't, obviously. And I don't know about you guys, but for most people, I find that they are just not very productive when they work at home. I mean, for somebody who's worked from home for years and years and years, I can tell you, you need a lot of self-discipline to do it. And, you know, people just haven't got that, especially if they've got distractions everywhere, then it just makes the situation even worse. So, and that shows in like the banks, for instance, like dealing with the Canadian banks is a freaking nightmare because a lot of them have been working from home, trying to get hold of people was a nightmare. It takes forever to get anything done. So it was far from ideal, even though those jobs could be performed at home. So the thing is, yeah, of course, we're never going to return to the level of people working in the offices we had before 2020. But the reality is that all these people, like, it's not going to be as much as they were saying it was going to be. Like, everybody essentially was going to be working from home. And now, as other people, I've even heard people like Dan say on his channel that they've had people reach out to him who are in that situation where they moved away. They're being called to the office now and they can't sell their house and they are totally upside down on the house and completely screwed. So this is where we're at, guys. This is where we're at. Absolutely insane time. So if you enjoyed this, please hit the like button. It is great. If you hit that like button, it greatly helps the channel. Sorry, I was reading David's comment here about Stoic Finance. I actually think that guy is awesome. He's pretty good. And it was funny because ScottWalters put me on to that guy. And I thought he's pretty good, actually. So good shout there by David. So it's and Josh had a re-warning on their live stream yesterday, Macro After Dark, about, I'll have to check that out. Thanks, all-nighter. So anyway, guys, thank you so much for watching this. I will see you in the next one. Video will be out on Wednesday. And I'll see you guys. Take care of yourselves, guys. Peace.